On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, all. Hope you're all well. We'll shortly take a look back at last week, which was a very eventful one across financial markets. But before that, one quick announcement. This will be the final episode of this year. At the end of this week, I've got a month off work. I'm not back until late January. So unless I feel the urge to record something and share some thoughts with you, you might not hear from me for about 4 weeks or so. This is episode number 90 for 2023. So there's been 90 episodes, and that must mean I've written about 100 odd reports as well, because there were a handful where I didn't bother recording a podcast episode on the back of them. So that's a lot of content, I think, when I look back, and I very much appreciate people listening to it and reading it. So thank you very much. We'll pick up where we leave off this week in early 2024. And over the break, feel free to send me through any ideas you've got about what you want to hear about, what you want to learn about, what you would like me to talk about. You know, the hard bit in this job is not the writing or the recording of material. It's the thinking of ideas and coming up with topics that people will find useful. So don't be afraid to help me out by letting me know what it is you would like to hear more about. The other favor you could do for me while we're asking for favors is you could rate the podcast, because if you rate it, that means it'll come up in searches and so forth, and it'll be brought to more people's attention, and more people will be able to get some value out of this material. Only if you're going to rate it positively. If you're going to give us 1 out of 5, then don't bother. But if you're going to give us a good rating, then that would be appreciated too. All right, back to the task at hand, which is to look back on last week for a start. And it was another great one for investors. Shares and fixed income both rising further. The S&P 500 index in the US posted a 2.5% gain, and it closed just 1.6 below the record high that we saw back in January 2022. European shares were up just shy of 1%. The UK market was up about 1/3%. And the Aussie market actually had a cracker of a week. It was up 3.4% last week, the ASX 200. That's the best week since July. The local market also had another solid week. It was up 0.5%. So that's the 7th week in a row that our market has been up. And that's the longest weekly winning streak since 2019, more than 4 years ago. So it's been a great run for the local market. And with 8 days to go, 8 trading days, the index is up 0.7% in 2023. So we've managed to edge our way back into positive territory. And the top performers of the index, if you're wondering, on the local market are Serco, which is up 91%. Sky TV is number 2, up 29%. And Fonterra, which is up 25%. So those are the top 3. At the other end of the spectrum, Pacific Edge has had a rough year. It's down 85%. Synlait and A2 Milk have also had difficult years. Those two stocks are down 73% and 41%. Interest rates, a lot of movement on that front, particularly in the wake of the Federal Reserve meeting, which we'll talk about shortly. But interest rates fell sharply last week. So in the US, the 10-year Treasury yield finished the week at 3.9%. That was down from 4.2% at the start of the week. And down at 3.9%, that's the lowest we've seen since July. And it's well below the 16-year high that we saw in early October. It's only 2 months ago. 2 months ago, there was a 16-year high of 5.02%. So we've gone from slightly over 5% to under 4% in the space of 2 months, which is a massive move. Similar story in New Zealand. In fact, a bigger story. We saw bigger moves last week. Our market reacted to the Federal Reserve meeting, and it then also reacted to the weaker gross domestic product figures that we got middle of last week. We'll talk about those soon as well. But our 5-year swap rate, which is a wholesale interest rate, fell 39 basis points. So it fell to 4.33%. And there were two occasions in 2008 and 2009 when we saw interest rates fall as much as that in the space of a week. And before that, you've got to go back to 1998 to find a time when we've fallen as much as that within the space of a week. So it doesn't happen very often. And being down at 4.3%, that's more than a full percentage point below where we were at just a couple of months ago. In October, we hit a 13-year high of almost 5.4%. And now we're down at 4.3. So a massive move. And investors who locked in some of those attractive yields around that time, sort of through October, and I recorded a number of episodes telling people to do that. So hopefully a few people took that opportunity. Yields just looked so good at that time, and it looked to me like they weren't going to stay that way. So I hope some of you took advantage of those market conditions, because you will have been well rewarded. And if we look at the NZX investment grade corporate bond index, which is a good proxy for private investors' fixed income portfolios, that index is up 6.5% now in 2023. So that sees it on pace for its first positive year since 2020, because it was down in 2021, down in 2022. So first up year in 3. And actually, that will be the strongest calendar year performance since 2014. So bonds this year, 2023, are having their best year in almost a decade. Right, looking back at some of those key events from last week, and the big one was the Federal Reserve. So this was the last Federal Reserve meeting of the year, and they left interest rates unchanged and pretty much signaled the end of their hiking cycle. So the Fed funds rate is sitting at 5.5%. That's where it's been for a few months now. That's the highest since 2001. And it looks like that will be the top. For a while there, the Fed was suggesting that there might be one further rate hike to come. They took that out of their forecasts. And now what they've got in their forecasts are 3 interest rate cuts for 2024 in the calendar year. They had 2 before, back in September. So they had 1 more hike, and then they had 2 cuts next year. Now there's no more hikes, and there's 3 cuts. So they have moved to a much more dovish sort of narrative. Financial markets, again, were already priced for that. Financial markets were already expecting rate cuts, and they had moved to see much less chance of any more hikes from the Fed. But they've moved even further now. So financial markets see a 75% chance of a rate cut coming in March, that being the first cut, and they see 0.25% cuts for the 2024 calendar year. So that's 1.5%. So essentially, financial markets see the Fed at the top. They see the first cut coming in March, and they see the Fed funds rate ending next year at 4%, which is 1.5% below where they're at today. So that's why you saw a strong rally in bonds and in shares. You know, time will tell whether things play out that way, because we've still got a lot of water to go under the bridge over the next 3 months, 6 months, 12 months, and expectations will change as that data moves. But markets are in very good spirits at the moment, and they are likely to end the year on a high note, on the back of those expectations that we're in for some monetary policy easing in the year ahead. We got another inflation report out of the US as well, and this came out a day before the Fed, pretty much in line with forecasts. There was a slight uptick in monthly price pressures, but at an annual level, inflation continued to decline. So the annual pace of headline CPI inflation slowed to 3.1%. That was pretty much in line with forecasts. It's just above where we got to in June. In June, the annual inflation rate in the US slowed to 3.0, and then it sort of bumped up a little bit. Now it's gone back down. And so aside from that June reading, we're at the lowest level since March 2021, more than 2.5 years ago. Core inflation, the core CPI, that's running at an annual pace of 4.0%, and that's been coming consistently down. Actually, it was unchanged from last month, but it's still been coming down apart from that, and it's at the equal lowest since September 2021. So inflation continuing to move in the right direction too. It wasn't just the Fed that we heard from last week. We also heard from the Bank of England and the ECB, the European Central Bank. They left interest rates unchanged in both cases. So the Bank of England is at 5.25%, the highest since 2008. The ECB is at 4%. That's the highest since the euro came into being in 1999. No one expected either of those to hike rates, so on hold was what people were forecasting. The rhetoric was probably a little bit more hawkish than we heard from the Fed. Hawkish means these two were still talking as if they're quite worried about inflation. The ECB is watching wage growth still quite carefully. So, they probably talked a little bit more of a tougher game than Jerome Powell and the Fed, who largely sort of moved to where markets were thinking. But there's still an expectation that the next move from the Bank of England and the ECB will be down, and people still see a lot of cuts likely to happen next year. So the second quarter of 2024 is where people see the most likely timing, and in terms of the total number of cuts through 2024, current pricing points to about 100 basis points of easing from the Bank of England. So that's 4 25 basis point rate cuts and 150 basis points from the ECB. So that's 6. That's pretty much the same as what's priced in for the Fed. So markets are very much expecting some pretty serious easing to come in 2024. To just round out some of the global releases, last week we did get the flash PMIs for December. These are purchasing managers indices, and they essentially reflect monthly activity, how it's tracking compared to the month before. A bit of a mixed bag. The US, very resilient, same as it has been for some time. A stable to slightly improving backdrop in Japan and the UK, and ongoing weakness in Europe and in Australia, in fact. So the US PMI rose to 51. That's a 5-month high. That's the 10th consecutive reading above the break-even level, which is 50. So the US still tracking along nicely. Japan saw a mild increase. They're at 50.4. So the services sector still ticking over in Japan. And of the last 12 months, we've seen them in expansionary territory above 50 for 11 of those 12 months. So that's good. The UK looks like it will avoid recession. Growth is starting to pick up a bit of momentum, sort of as the end of the year nears. So their composite PMI improved to a 6-month high, 51.7. So you look at the last 3 months of the year, and the UK is probably somewhat stagnant, but it's not weakening as much as some places. Australia and Europe still looking the weakest. Activity across the Tasman contracted for the 3rd consecutive month. Conditions are still quite soft. Still points to a soft landing rather than a hard landing, but the economy is definitely slowing. And in Europe, things looking pretty weak there. Their PMI was 47.0, so that's the 7th month in a row that it's been in contraction, and there's just not many signs of recovery at all. And the prospect of a recession is still higher than most, I think, for Europe. In New Zealand, so the big one for us was the GDP report, and this was for the September quarter, and it was much weaker than expected. So GDP fell 0.3% for the quarter. The market was expecting a gain of 0.2. The Reserve Bank was expecting 0.9. So it was weaker than market expectations and much weaker than Reserve Bank expectations. On an annual basis, GDP fell 0.6%. So that's again below market forecasts and further below Reserve Bank forecasts. The goods producing industries like manufacturing and so forth, they were the ones that were very weak, and they represent probably 20 odd percent of the economy. Primary and service industries managed to eke out small gains, but not much. And they weren't enough to offset the falls in manufacturing and the goods producing industries. So this result is particularly weak when you consider that we've seen population growth over the past year of 2.5 to 3%. So on that basis, if you've got the economy shrinking by 0.6%, then it's really contracted by more than 3% on a per capita basis. So on a per capita basis, definitely in recession, and that's why I think it probably feels like a recession. Not a major one, but a mild one for many households, because at an individual, at a household level, that's absolutely what is happening. The other thing that was notable was they revised the previous GDP figures. So remember, we had the 2 quarters of contraction, which were very minimal in terms of the level of contraction, but some people considered that to be a recession of a very mild magnitude. And then we had those were revised back into positive territory, so that technical recession, we had one, then we didn't have one. Well, we've got one again now, because they've gone back and they've reworked the numbers for the final quarter of last year and the first quarter of this year, and they're back in negative territory. So, this is what happens as they revise the data. And this data might get revised as well, so time will tell. But look, it was weaker across the board, and I think that has played a big role in the interest rate moves we've seen, because if you've got growth and activity indicators that are much weaker than the Reserve Bank was expecting and forecasting. And we also had some food price figures that were much weaker that pointed to lower inflation as well. So all of these things have changed expectations for the Reserve Bank, which next meets in February. And market pricing has moved to suggest there's about a 30 odd percent chance of an OCR cut in April. And markets are fully pricing a cut by May, which is not far away. And markets are pricing 4 cuts over the 2024 calendar year, which is not quite as much as they see ahead for the Federal Reserve or the European Central Bank, but it's probably in line with what they see for the Bank of England and the UK. So some big moves and some big changes in expectations there. So it will be really interesting to see what the Reserve Bank thinks about some of these indicators and whether they agree with the takeaways that financial markets and many economists have interpreted them. We won't know till February, and there's a few things to come out between now and then, but that's where we're at the moment. Also got some house price data for November, and this was pretty solid. There's further evidence of the market improving, prices continuing to rebound, and activity still solid. Mortgage rates still at very high levels, but it'll be interesting to see where they're at in 6 months' time. One would think mortgage rates are somewhere near a peak if you believe those market expectations of what the world's central banks will do and where inflation and activity are going. Right, looking to the week ahead, and we'll start locally. It's quite a bit happening actually on the local calendar. We've got domestic business confidence for December, so the final edition of the ANZ Business Outlook survey will be released on Tuesday afternoon, 1 o'clock. A month ago, this pointed to another strong rise in sentiment. We had the headline index increase to the highest level since April 2015, so 8 years ago. Own activity also increased further, and this is the one that is a much more useful leading indicator for activity. It's at the highest since July 2021. That'll be an interesting one to watch, because it does have a history of correlating well with future economic growth, and now people are starting to get a bit nervous about the growth picture. Watching indicators like this are something that we should be doing and taking more note of. So this survey will be interesting. We'll also be watching for any changes in terms of inflation expectations or pricing intentions from firms. So that is Tuesday afternoon. The next day, early Wednesday morning, we've got the last dairy auction of the year. Looking at the year overall, dairy prices are down about 5.5%, although the Kiwi dollar has slipped slightly. It's risen a little bit lately because you've had the US dollar coming down, particularly in the wake of a more dovish Fed. But we're still down about 2% this year, so that will slightly offset what we've seen on the GDT price front, but still been a relatively subdued year. And Fonterra has the forecast at the midpoint, at least in terms of its range, of 725. That'll be the lowest in 4 years, and a few people out there picking it to be revised higher in the months ahead. So let's hope that this week's auction gives us a bit more confidence that that might happen too. Later on Wednesday at 1 o'clock, we will get the Haifu, which will be closely watched. This is the half-year economic and fiscal update, which always comes out just before Christmas. This time it'll be more interesting than usual because it will be the first time that we see the Treasury incorporate all of the policies from the new government into the outlook. There's still some uncertainty there because while some parts of the policy agenda are quite clear, like we know that there's tax relief coming and we know when, there are other areas of uncertainty. And the main one is probably where will all the spending cuts come from? There has been quite a short turnaround between the government being confirmed and then this material being prepared. So Treasury probably will have to do a bit of guessing in places, and that might mean some of these estimates will change. You know, if you cast your mind ahead to May when the budget is, we'll probably get a bit more clarity then. But it'll still be interesting to see how the Treasury views not only the outlook but the impact of some of the policy changes on the numbers. Looking further afield, the key release in terms of US and global economic indicators will be core PCE inflation for November. So this will be out on Friday, so we won't get it until Saturday. This is one of the Fed's preferred inflation measures, and it'll be the last release this year. So markets are expecting the headline PCE inflation to be flat for the month. And that would see the annual rate slow to 2.8, which is down from a peak of 7.1% last year. That'll be the lowest since March 2021. The core PCE, which is arguably more important, that's expected to go up 0.2% for the month, which would see the annual pace of inflation, core PCE inflation, slow to 3.3%. So that'd be down from 3.5 a month earlier, and that'd be the lowest since April 2021. And in the Fed's forecasts, which came out last week, they had core PCE inflation slowing to 3.2 by the end of the year. So this will be 3.3. But remember, this is for November. You know, the December data, it'll still have a chance to sort of go down and meet that Fed forecast. Then they've got that falling to 2.4 by the end of 2024. So this will be important because if it doesn't come down as expected over the next few months, then that will bring into question whether the Fed will indeed be able to ease monetary policy to the degree that it and financial markets are hoping. The Bank of Japan will be the central banking highlight. So after that flurry of central banks last week, we'll get the BOJ's final meeting of the year, and that will be on Tuesday. It usually is sort of after lunch that you start the results start hitting the news wires. Don't know if they'll make any changes this week. Generally, markets expect the Bank of Japan to inch closer to ending its negative interest rate regime. Might not happen this week, but that's definitely a story for next year. So we will be monitoring the language they use quite closely. They're still in negative territory. They've got negative interest rates, which puts them in a very different position to all of those other central banks. We've seen the Fed, the ECB, the Bank of England, the Reserve Bank of Australia, the Reserve Bank of New Zealand, all hike interest rates really aggressively over the last 18 months, 24 months. And now they're at a point where they've got to the top of the hill and we're all speculating on when will the first cut come. Will it be March? Will it be April, May, August? And the Bank of Japan is in a very different position because they've had negative interest rates right the way through. and they will be the ones that are tightening monetary policy and probably withdrawing that sort of stimulus and that stepping away from that yield curve control that they've had in place to keep interest rates down across the board, and potentially sort of moving their short-term policy rates back into positive territory. So that's going to be a real story for 2024, and it has market implications, because if you've got every other central bank in the world cutting interest rates, and then you've got one who is putting them up, then that could potentially see the Japanese yen perform quite well, which would be good for investors on the one hand, although it will potentially be a headwind for some of those Japanese exporters. So, lots to think about there. But Japan is shaping up as a really interesting economy to keep an eye on next year for a range of reasons. It's actually been one of the best performing parts of the world this year in terms of equity markets. We all talk about the US, which has had a great year. It's been up, what is it, up 23% as we sit here today, year to date. Probably 25, 26 if you include dividends in that. But the Japanese market has been stronger again. And that's pretty much all we have. Just checking if there's anything that I've forgotten. Oh, we will get a couple of inflation reports out of the UK and Japan. Those will be worth watching too. And on the corporate front, there's a couple of companies reporting earnings internationally this week. FedEx, always an interesting one to watch. Their result is out on Tuesday US time, so it's sort of Wednesday when we get it. FedEx Tuesday, and then Nike on Thursday. Nike, fantastic business. Yeah, always learn a lot from Nike, because they do have a lot of touch points around the world, and they do, you do learn a bit about the consumer. You learn a bit about what's happening in places like China as well from Nike. FedEx is a good bellwether. It's, in the same way that in New Zealand, we all watch the likes of Freightways and Main Freight, and we learn things about what's happening, right at the coalface there. FedEx can be a bit of an economic activity bellwether in the US. So that's what we will be watching. And that is it. So thanks again. Much appreciate your support and listenership over the year. Definitely be back. In all likelihood, you'll hear from me at some point over the break. So just seems like such a long time to sort of go without actually getting in touch with people. So I'll be very surprised if I go a whole month without finding myself with something I do want to say. So stay in touch, and we will talk again soon. Merry Christmas, everybody.